Hello everyone, welcome to our first office hour of 2025. Uh, yes, Today we will be going through guaranteed residual value and reductions and incentives. So let's start with guaranteed residual value. So, what is residual value? It's the estimated value of a fixed asset at the end of its lease term or useful life. And guaranteed residual value is an assurance that we give to the lessor that the value of an asset at the end of the lease will be a minimum specified amount. And we will be setting this up at the lease component in the terms and condition. And we have estimated residual value, which is the estimated value at the end of the lease term. And the expected residual value is it's the difference between the guaranteed residual value and the estimated residual value. This is the actual amount that we pay to the lessor to compensate for any, let's say, deficit. And it is set in the activation group terms and condition. Now, to set the guaranteed residual value, we can go to the lease component level, and then while adding a term, we can you can use the field for GRV. This is again actual, it's not an actual amount that we are paying, it's just a guarantee to the lessor. And then after activating the lease component, we can go to the activation group, and this is where we set the actual payment. How much is the deficit that we are going to pay to the lessor to compensate. And another thing to note is if we have multiple guaranteed residual value, the value for the last term will be considered. For example, if we have like GRV defined in both base rent and extension, and both are likely to be excised, the guaranteed residual value that is set at the extension will be considered. And if the extension is not excised, then the guaranteed residual value for the base rent will be used. Now let's look at a scenario. We have a base rent for $1,000, and the lease term is from 1st Jan 2025 to 31 December 2025. The guaranteed residual value is 20,000 and estimated residual value is 5,000. So the expected residual value is the difference between the guaranteed residual value and the estimated residual value. So the payment, that the actual payment is supposed to be 15,000. So the 20,000, which is the guaranteed residual value, it will be set at the lease component level in the terms and condition. And the expected payment, that is the 15,000, that is this 15,000, it will be set at the activation group level in terms and condition. So here we can see the guaranteed residual value that we set at the lease component, terms and condition, and here this is the actual payment that we make. And let's say if we miss this step in the AG, then that means there is no extra payment required, and the this will be shown as zero, where we are not making any extra payment. Otherwise, we have will be able to see the maximum amount of GRV in the schedule and the expected payment over here. The total minimum lease payment would be the actual lease payment plus the expected payment. Do anyone have any question? Okay, let's look at GRV in the system. Here I have a contract, and the yes. Do anyone have any question? No. Okay, so here we have a contract, And we have the contract rate 2%, compounding frequency monthly, and I can set up the lease component level. So I'm creating a lease component. I'm naming it 5. And here we can set the asset classes. And then I can go to the terms and condition and add a new term. I have a base rent, let's say 1,000, and amount frequency is one time, payment frequency monthly, and my first payment date is on 1st January 2025 until December 31st, 2025. And my GRV, I'm setting it as 20,000. And expected start date and end date, it will be the same as, I'm keeping it same as the payment date. And I can submit it. So I can go to the contract level and I'm sending it to approval. And in the activation group level, I can go to terms and condition and I can open this term. And this is where I set the actual payment that we are supposed to give. So 15,000. And then I can send it to assessment. At this point, we have a preliminary schedule. We can go into the schedule and check. New schedule, all column. And here we have okay. And here we have the maximum GRP, which is the guaranteed residual value. And this is the expected payment. Let's say we have an extension. So I'm going back, going to the contract level, fall back, and these component terms and condition. I can add a new term, extension. Amount frequency is one time, payment frequency just like the base rent. And I have the first payment from 1st Jan 2026 to December 2026. And the TNC end date is December 2026. And here I have another GRP, let's say 10,000, and submit. Now we have the first base rent where the GRV is set as 20,000. So the expected payment cannot go beyond 20,000. And then we have the extension where the GRV is set as 10,000. Now let's go and approve the contract. And go to the activation group level. And over here, I can set the expected payment. So this payment should not be more than 10,000. So I'm keeping it as 5,000. And I am also exercising this term. In this case, since we have expected payment in base rent as well as expected payment, let's say 15,000 as we did before. Since we have base rent and since we have GRV in both base rent and extension, the GRV at the extension will be taken into consideration. So here we will see 5,000 as the expected payment. So let's see. We are sending it to assessment. Let's go to the schedule. All column, all year. Yeah. So it's 10,000 and 5,000, which is set in the extension term. Do anyone have any question?